We're still getting some good flow in here, participants, but it is 12:01, so let's
do it.
start and they can catch up. So we do have a lot of great topics to talk about today that we take from the newest edition of the firm's quarterly market update slide deck. We have inflation, the timing of interest rate cuts. We have a recession still on the watch list, 2024 return forecasts, an election on the horizon, and more. But first, for those listening who are not clients yet, marketing would be upset with me if I didn't share a brief introduction about the firm. And it is the great folks in marketing that allow us to do these podcasts. So let's keep them happy. My name is Austin Hageman, and this is my colleague, Adam Armstrong. Our firm is a white glove wealth management firm. The firm registers with regulators in a way that legally binds us to act in our clients' best interests when providing solutions all the time. And whenever we're providing a solution, we are legally bound to act in our client's best interest. And this is pretty powerful and can only be said by roughly 15% of our competition. The other roughly 85% actually don't need to always act in their client's best interest when giving investment advice. We also operate independently from other providers in the industry. Staying independent from commercialized product and service-based companies puts us in a position to remain impartial when giving advice and, when necessary, negotiating terms with other providers on our clients' behalf. Did I miss anything? I think
You got it. You got it.
So let's keep moving along. I will remind everyone that you can ask questions. There is a Q&A box if you have questions along the way. We did have some questions come in prior to the start of the webinar. But let's jump to inflation, Adam. How about that? You want to give us an update?
I'm kind of sick of talking about inflation. Maybe that's because it's not a problem anymore, or maybe it's because we've, beaten a horse to death. But look, inflation's back down. The latest reading was 3.1, 3.2% on an annualized basis. So that's far more normal, below, at or below the long-term average. It's higher than where we were for much of the last decade or bull market, but we've come a long way from the dog days of inflation.
A long way from 8.9%.
Yes. Yeah. Thankfully. The Fed has done its job. I mean, dare you say they've won this war on inflation? This is just showing the last 12 individual months of data. We've shown this a number of times on each one of our presentations that we've done over the last couple of years, but we're making progress, continuing to see flat months, very little inflationary months, which is great. You can see January and February of last year, there was almost a full percentage point of inflation in just those 2 months. So possibly by the time we get the March reading, we could be near that 2% target, which is the Fed's, goal here. So we'll see how these next 2 months shape out, but things are looking good.
Right. And the 6-month data is supporting that, right?
Yes. So this is just showing, okay, what if we only look at trailing 6 months of data on an annualized basis, and core prices are below their 2% target. They're actually at 1.9% annualized rate over the last 6 months. So I think if the Fed is, I don't know what the Fed's looking at. They have a lot of data that, we may see or may not see, but if they're looking at this, then they've got to be giving themselves a pat on the back right now.
Right. And this is important, right? Because the 2%, that's the Fed's target, right? Their long-term target's 2%. The reason why they increased interest rates is because inflation was far exceeding 2%. Now that we are seeing inflation come down, the 6-month annualized data is showing us that, we are trending in the right path to be at that 2% or under 2%. That could mean that the Fed can take their hands off the neck of the economy, right, and allow interest rates to come down.
Yeah, a lot of rates have come down, not their short-term rate, but across the board, this last quarter, really in the last 2 months of the year, we saw interest rates come down a lot. Whether it's the 1 year, the 2 year, the 5 year, 10 year, across the board, rates came down, which in and of itself is a form of easing. So it's possible that a lot of just the anticipation of cuts has made financial conditions easier out there, right? What was
Right.
8% mortgages back in September. Those have come down anecdotally. I've heard from clients, friends in the low sixes already. So big jump there, much easier on the consumer, which is a good thing for the economy.
Right. And speaking of anticipation, I think the Fed dot plot is important to look at. And we have
We're
marked in our
scrolling
dot
through
plot.
some slides here. If viewers are interested, any of your advisors that work for the firm can walk you through any of these slides. But this is a great slide. We've touched on this before. What this is showing is the Fed dot plot, it's called. It's where each of the individual Fed members projects interest rates will be at the end of these given years. And the last one came out in December, so they all projected that they were done hiking and cutting rates. So we landed at sort of this 5.25 to 5.5% range in 2023. Now, the big question mark is how many rate cuts will we see this year? When will they come? How quickly will they continue over the coming years? And on average, you can see that the Fed members project around, 3 rate cuts in 2024. Okay, down to 4.6%.
So each of these black dots is actually a Fed member, right? And where they think that the rates should be come the end of 2024, right? And that gets us to this 4.6% number.
Right. So there's 2 dots there up at the top of this column that are exactly where they are today. So 2 people on the Fed board actually do not want any rate cuts this coming year, this entire year. Okay. And there's someone actually out in 2025. I don't know who they are, but there's someone who doesn't think there needs to be any rate cuts for 2 years, actually, which is fascinating, incredible. I don't know that would be a good thing for the economy, but maybe they're focused on really making sure inflation goes away permanently. But we have 2 numbers on the screen. So there's a 4.6%. So on average, the Fed members think that there will be about 3 rate cuts next year. Now, the 3.9% is actually what the market, based on Fed funds futures contracts, is projecting. And so we have this discrepancy again. We saw this all through the year last year, where the Fed kept saying, we're going to hike rates a lot, we're going to keep them higher for longer. And the market just didn't believe it. They never thought they would hike rates as much as they did until after the fact. And now we have this similar phenomenon where there's a dislocation in the markets. The market is actually saying, no, you're going to cut rates. We think you're going to cut rates more than what you're saying.
A lot more.
So 3.9% would be 6 rate cuts? So
Right.
double the amount of rate cuts before the end of next year. Now in 25 and 26, we're, off by a cut, maybe in each of those years. So I think
these numbers come together.
Exactly. So I think long-term expectations, the market is aligned with what the Fed believes. It's just this short term that is, again, it's creating a dislocation in the market, which can create volatility.
Right. And I think that's the big takeaway here. I would, venture to say that maybe the market, the investor, is trying to price in rates to perfection, where the Fed might be being a little bit more cautious, right? Because they don't want, the 70s, a resurgence of inflation like we saw in the 80s, where the Fed started to lower rates, but then inflation started to climb back up and the Fed needed to go back on that. So,
Right.
It's quite possible that the Fed's being a little bit more stubborn just because they want to make sure that, they want to really make sure that everything's all right, where the investor might be saying, or the marketplace might be saying, yeah, you know what, it's time. Or they could be saying, maybe we are going to have a recession in 2024, and that's going to force the Fed to move rates down quicker than they think.
My guess, we actually had a question. What do you forecast for interest rates in terms of the decreases in 2024? My guess is you're exactly right. The Fed does not want to show their hand and say, yeah, we're going to do, 10 rate cuts next year. And then all of a sudden, tech stocks come zooming back like 2021 and There's too much money flooding the system. Liquidity is too easy to obtain, and inflation rears its ugly head again. They don't want that scenario. Um, is the market overestimating the cuts? Probably. I think there's also some degree that if we get a recession this year, the Fed's estimate of 4.6% is probably too high. If
Right.
we do start to have some negative quarters of GDP or unemployment starts rising, above their full employment target, I'll say, because that is their other goal, right? One of their goals is price stability, low inflation. Their other goal is full employment. What does that mean? 3-4% unemployment? Okay. Well, if the unemployment rate jumps to, let's say, 4.5% halfway through the year, you could see them start cutting more than what they're forecasting today to accommodate the labor market again, right? So I think there's probably some middle ground here, but the biggest issue is how do we minimize volatility in portfolios? And if you're a bondholder, that's a large portion of some people's accounts. What do you do in this type of scenario? There's not much you can do, but we just have to be aware that any dislocation, whether it's stocks and valuations and their earnings, or it's bonds and interest rate expectations versus the reality, that can cause volatility that can spread across asset classes.
Yeah, I think it's important just to understand from this chart that it's important to accept the potential for higher volatility this year, given the dispersion and where the Fed thinks rates are going to go versus where the market is. Anytime there is a data point that comes out that may suggest inflation is going to stay up higher for longer or even creep up, that will likely send equity prices down, right? I would imagine that the market's going to overshoot on the downside there. Anytime we have a data point come out that may suggest inflation is still moving its way down and it's going to hit that 2% target, I would expect stocks to shoot up and overshoot on the upside. So we need to expect coming into 2024 that additional volatility. And I think where investors tend to make mistakes is trying to guess what's going to happen between point A, point B, point C, and point D. When we know where point A is, right? We're here. We know where point Z is, somewhere around a 2.5, 2 to 3% Fed funds rate once inflation actually gets to where it needs to be. And along the way, if we could stay invested in equities or stay invested in whichever risk-based asset you're invested in, along the way, that should prove very well for equity investors. Equity investors should be rewarded by holding true through point A to point Z. If you're going to try to guess what happens between point A and B and C and try to time the market that way, that's where investors tend to run into trouble because that's where there's more uncertainty.
It's worse to get it wrong than just ride the waves.
Correct. And getting it right is just holding still, right? If you stayed invested from this point on to a normalized market, I would consider that right, even if along the way there were ups and downs. So let's jump to recessions, right? I think that coincides well.
Right yeah, there. Specifically, we're going to talk about the leading economic index or indicators index, the LEIs. This is something we've shown for 3 or 4 slides, iterations of this slide deck now. The leading economic index has been flashing this recession signal, which is supposed to lead a recession by, on average, 7 months. It's not always 7 months. Sometimes it's less, sometimes it's more. COVID's a great example, right? This flashed in March of 2020. It led the recession by 0 months. But I wanted to focus on 3 things, right? There's in the actual language of the Conference Board who publishes this index, they talk about these charts. And reading through it this past week, they talked about the 3 Ds, okay? And those stand for duration, depth, and diffusion. Duration represents how long the indicators have been in a contractionary period. The depth signals how bad is the contraction on an aggregate level. And then the diffusion is how widespread are the actual, you can see the 10 indicators down there. How widespread are the contractions? Is it just some of the indicators that are contracting at you know, at a faster rate and dragging the whole index down, or is it everything that's contracting? And what we've been seeing is it has been widespread at times, but at the current moment, it's really not very widespread. There's new orders are slowing. The interest rate spread, for example, has been getting better, right? The yield curve has actually been flattening since the Fed announced that they were going to be cutting rates. The S&P 500 is in here. That's one of the indicators. That's been a great improvement. The market, I don't know where it is this moment, but yesterday closed at an all-time high, right? So that's a positive thing. So I would also, point you to the depth on this chart. You can see that the depth that this leading economic index got to in terms of its declining growth rate was shallower than in 2001 and 2008 and in COVID. So it's possible we've just seen what we talked about this last time and the time before, but this rolling recession theory, where over the last 2 years, you've seen different pockets of the economy, whether it's tech in 22, or maybe some consumers that are slowing now, or, different industries that are slowing at different times. And we never really get this true 2 negative quarters of GDP. Or, that's the more traditional version of a recession, but unemployment rate hasn't really been rising all that much, or as fast as you would expect given these circumstances.
Right. So instead of the recession hitting everything at once, we've been seeing signs that it's been hitting specific industry, specific sectors. And maybe that has to do with the strength of the consumer. I mean, the consumer has remained strong pretty much throughout this whole episode with the Fed, right?
Yeah, it could be. Look, rate hikes we know have long and variable lags. We don't know how long it will take for the rate hikes to permeate their way through the economic system. And we don't know how long it will take for that to really cause pain once it does get into the system, right? And you and I have talked about this a lot, where so much of our debt as individuals today was locked in. First of all, a lot more of it's fixed than ever before. And the biggest part of most people's debt is their mortgage, which over 2/3 of people have mortgages under 4%. Most people are not getting new mortgages at 6, 7, 8%, where they were this past year. So it could be that these lags are going to take a lot longer, or maybe they just don't have the same impact this cycle around, given the fact that rates were so low last cycle and everyone took advantage of it.
Right. Right. Now, where these 10 leading economic indicators are telling us one thing, right? We have this blue line coming down, and then it looks like things are actually getting a little bit better.
Right. So this is still negative. We are still contracting as far as the leading economic indicators are concerned, but they are not contracting as fast as they previously had been. And
right.
I think that, let's think about the narrative this time last year was, it's pretty likely there's going to be a recession in 2023, right? We talked about that. Market pundits were talking about that. What's the narrative now? The narrative now is we're probably not going to have a recession, right? So the sentiment has kind of followed, this chart, if you want to look at it that way. Now, to your point, if we look at coincident indicators, so leading economic indicators are things that should be leading and forecast an economic recession. Coincident indicators are things that decline as the economy is declining itself. And we focused on this last year, this time last year, because the blue line here on the chart was spiking, and I'll explain it. Or do you want to take a minute to explain what we're looking at here?
Sure. So what we're looking at here is, of the US states, which states are reporting that they are slowing. Okay, so when you have this blue line moving up, you're having more states indicate that they are slowing. When you have more than half the states reporting that they are slowing, typically that is a sign that a recession could be coming.
Correct. So at least it could signal that we're in the start of the recession, right? And so while on a leading basis things are improving, this kind of flies in the face of that last slide and says, actually, if you look at what each individual state is doing currently, economic conditions are slowing across, what is this, 32, 33 states are reporting coincident indicators that are slowing and retracting. Okay. So this is, you can see here the +2 standard deviation. So, 2 standard deviations above what is normally slowing during good economic times indicates a very high recession risk at the moment. So this is, I don't want this to be a sign that, hey, the recession is here and it's now. But at the same time, this could mean, again, with that rolling recession theory, this could mean that there are a fewer number of states that are overall contributing much more to the countrywide economic output. And I think that's probably what's going on here, because on an aggregate level, if you look at the level of this index across the country, it is still modestly improving. Okay. So even though there are more states showing contractions, you are seeing the overall level of the economy continue to grow, and GDP supports that, right? We're continuing to see this sort of 2 to 3% annualized GDP growth, and typically you have contractions, and then you have periods of very strong, high annualized growth rates, and we just haven't seen that. We never saw the contraction, and we never saw an acceleration of growth either, which I think is really interesting, and probably again supportive of that rolling recession theory.
Right. I would almost rather have us see a light recession, kind of take our medicine, get that behind us. Because if we continue without seeing an official recession, right, then the question's always going to be, I think it's going to be for a longer period of time. When is it coming? It's got to be coming soon. You're kind of waiting for the next, shoe to drop or the next thing to jump out at you. But at least if we get the recession, then, we can look forward from there.
I think that's what you saw in 22. Business owners and businesses, they thinned out their inventories, right? They drew down their inventories. They laid people off. You saw people preparing for a recession, but it never came. The consumer has been by far the most resilient aspect of this economic cycle over the last 2 years, I would say. The consumer possibly saved the economy from a recession over the last 2 years, right? That pent up demand from COVID in 22 and 23, it continued on of traveling and buying things they had been putting off or spending excess dollars. So, I do agree. I almost think that a mild recession would be good for the long-term health of the economy. And really, you can still see pockets of excess where, if you look for it. I think it's not as egregious as 2 years ago, but the excesses, I'll say, but there are still things that seem excessive.
Right, exactly. So you think we beat inflation over the head?
I hope we can.
Time to move on from this conversation here.
Put it past us.
So it is the season for market forecasts, right? You turn on the TV, you open up a newspaper, and you will most likely see some sort of analyst, some sort of economist having their forecast for the year ahead, where it may land. You want to talk to us a little bit about, how those typically pan out?
Not well. I'll start by saying that. First of all, I think it's a little interesting that all of the big banks that put out these forecasts, they do so in like November, in mid-November, really before Thanksgiving. And so if you think about this year, what happened in the market over the last 2 months, what was the S&P 500 up? 12%, 10% in the last 2 months of the year. Small caps were up even more than that, I believe. a lot of the forecasts by the time the year actually ended were already stale. Even the bullish forecasts were under where the market actually was, which was a bit ironic. But essentially what we're looking at here, the gray boxes on your screen that you see for each year are, thank you for highlighting that, are the range of the observed forecasters. Okay. So what you can see is that the dashed blue line is kind of the median forecast, the midpoint, if you will. They all kind of hover at the median forecasts every year, good year, bad year, recession, coming out of a recession, whatever it is, the median kind of hovers right there around this 6 to 10%. There's not much career risk in forecasting a 6 to 10% return. That's what the market does on average. That's what most people do on average. That's what the median typically is on average. Okay. So if you just hug that 6 to 10% forecast for the S&P return next year, you're probably going to be, very successful in your career. You're not going to be right necessarily though. Okay. And that's what these blue diamonds are. The blue diamond is where the market actually ended the year from a return standpoint. And what we can see is, looking out over the last 10 years or so, 3/4 of the time, the market doesn't even land within the high and low forecasts from a lot of these.
Right.
These
Literally nobody was correct. You have all these different analysts and economists and banks out there putting out this information. And for the most part, they're only within their high and low bands, within the highest expectation versus the lowest expectation 25% of the time. That's not a great batting average.
No, I mean, look, directionally, they're right sometimes, or some people can be right. If you're forecasting for 0 or -3% and the market's actually down that year, I don't know. Are you right? I guess.
Right. Does that mean if you say the market's going to be up 5% and it's up 20, you're right? I don't know. Right.
I don't know. But we know that the market typically, it either goes up a lot or it's down. Right. There's usually not many years that are just an average return. So why people just say that it's going to be an average return year is beyond me. Ultimately, what we're trying to say by showing this chart is just ignore all the forecasts. They're probably going to be wrong. Something's going to happen at some point in that year to change your forecast. I mean, look at 2020. I don't think anyone in November of 2019 was forecasting that there would be a pandemic and a 35% drawdown in the S&P 500. Right.
Or in March of 2020, predicted that we were going to end the year up.
Right. Well, that's the thing, is that in March of 2020, everyone went and revised their forecast for the year. Okay, great. Well, guess what? We overcame the pandemic. And look, the market was up, 18% that year? What purpose does this really serve? It does give us actually some insight. They all basically pull two levers. They look at what's the earnings growth going to be, and what's the multiple that we want to assign to that earnings growth, right? And then you can say, okay, if the S&P is going to grow, earnings are going to grow by this much, and we're going to trade, people are going to be more optimistic or less optimistic, and we're going to trade at a 16 multiple or an 18 multiple, et cetera. That's how you arrive at value. So really that's all that these folks are doing, is they're pulling these different levers.
Right.
So let's look at 2023. How did people do last year? We know it was a great year last year, and I promise we're going to get to 2024. We know it was a great year. The year started around 3,800. Started off with a bang in January. We had the banking crisis in February, March that pulled us back a little bit. Then AI stocks just took off, right? NVIDIA, Microsoft, Google, the big, what's the new acronym they're called? The Magnificent Seven.
Magnificent
right?
Seven, Mag 7.
I hate that. But anyways, stocks took off. And then in September, rates just really started to skyrocket. Okay. This is, September, October timeframe is when you had the 10-year treasury trading above, I believe it traded at or just 5%. Above 5%. kudos to anyone that locked in 10-year treasuries at 5%. You had about a half a day to do it, but good on you. And then there's this massive pivot again in November of last year. It was really the end of October, I think the 27th, where Powell came out and they said they're likely done hiking rates. The next move is probably going to be lower, and the market just took off, right? But let's look at the forecasts. Okay, so last year, poor Barclays down there, they were
they tried to be unique.
That's what you get. That's the career risk we're talking about. So they stuck their neck out, and the guillotine was not kind to them. But look, they forecasted probably for a recessionary environment or something, pessimism, earnings retractions, whatever it might have been. But these lines really get thin and are mostly populated right around this 4,000 to 4,200, 4,300, if you want to call it that. Coincidentally, Austin, those levels coincide with a 6 to 10% return. Go figure, right? So I believe Yardeni Research, which is not here on the screen, had a 4,800 price target. Your prize is in the mail. Good job. There was someone else with a $5,000 price target, but ultimately what we wanted to highlight were the big banks here. And look, were they right or wrong? I mean, directionally, they were forecasting for earnings growth. That happened. Some of them were forecasting for more multiple expansion. That happened. But again, even the high on this list of 45.75, and again, this was a snapshot taken at the end of last year, the end of 2022, I should say, was underwhelmed, right, by a couple hundred points on the S&P 500.
Right. And I think this is just a really long-winded way to say it's better to focus on the long term. The short term is just it's too hard. There's too many variables. The empirical evidence has shown that longer term trends, you can identify them. Those you can make smart investment decisions based on longer term trends, but focusing on the year to year, that's when it gets too tough. And it also highlights that you can run into trouble when making an investment decision on, just one or just a few projected outcomes, whether it's where the market's going to end, when rates are going to start to come down, you name it. If you're focusing on just any one of those what ifs or projective outcomes and making investment decisions based on that, that's when you can run into trouble. We find it's better to make investment decisions that account for, to at least some degree, all the potential what ifs, and lean into that longer term trend so that you remain diversified. And regardless of what the market ends up doing, right, you can somehow find a benefit to it, right? Your portfolio will somehow have an allocation to that piece of the market or that type of investment that is benefiting in that environment, as opposed to putting all your coins in one, in one bet and being wrong.
Right. I mean, unless your time horizon is genuinely just 1 year, you probably shouldn't even be invested in the market anyways. But everyone's time horizon is longer than that. And what happens next year or the year after, it really has no impact. And these businesses are just going to continue to try and add value for shareholders. That's what CEOs are supposed to do. That's what they're tasked with doing.
Right. And since we have the returns of last year up, I think it's important to note this period here that you touched on where inflation was looking a little hotter and the market it looked like it could become a little hotter and the market started to really sell off. And then, the Fed comes out and says, we think we're probably done raising rates, and the market took off again. That's the type of volatility I think is appropriate for us to expect in 2024. I'm not saying that the market's going to end up down or even up, but I'm saying that's the type of volatility I think we should expect, because what the market's trying to do is they're trying to price the economy a year ahead of time, a year plus ahead of time. So, if you think about it, if you move slightly in any one direction and then you bring that out a year, you end up with points on the graph, they're very far apart just because that time horizon that you're looking at is so far. So the market's going to keep reacting and likely overreacting to news. And we need to expect that, we need to be prepared for that, and we need to be willing to hold on, because again, we want to get from that point A to that point Z, the B, C, D, E, F, G, all of that nonsense in between, right? That's where we can make mistakes.
That was a 10% correction, I believe, from July 31st through the end of October.
Right.
That was a 10% correction. The year finished up 24%, 26% on a total return basis. So we were up 24% and we had a 10% sell off midway through the year. For 3 months of the year, we had a 10% sell off. So markets move quickly. They don't care what you think, right? And you just don't want to be caught on the sidelines.
Right. And we do
one of Warren Buffett's favorite quotes of mine is, you only know who's swimming naked once the tide rolls out, right? So let's all keep this PG and just stick to our strategies.
I won't comment on that. So we do have someone to thank for that great performance last year, right? We have our mega caps, our top 10 stocks. Why don't you explain a little bit of what's going on in this slide?
Yeah, so a lot of this was AI driven. The big players, we've talked about AI last summer. You can look up that webinar if you want to dive deeper into AI. But we just want to focus on the performance dispersion here this year. The top 10 stocks contributed almost 90% of the return of the S&P this past year. Okay, so the top 10 market cap names, think of the biggest household names out there. I think you can throw in like Berkshire, JP Morgan, maybe United Healthcare, along with the Magnificent Seven, probably. But they contributed, and that group, the top 10 market cap, returned 64% if you just held those top 10 names. Now, I think this is important context to say that if you held all those names in 2022, you were down much more than the market was, right? Amazon was down 50% or so, Google as well. Facebook was down more than 50%. So this is maybe this was warranted, a bounce back for some of these names, if you will. And you can see the S&P 500 there is the gray line at 25%. And then the remaining stocks, so the other 492 or whatever it is, I know it's the S&P 500, but technically there's more than 500 companies in it. The remaining stocks only returned about 13% or 8%, excuse me, right? That was just 13% of the total return of the index. So this dispersion, believe it or not, it didn't happen throughout the whole year, right, Austin? I think it was just the first half of this year.
First half of this year, yep.
And it was mostly actually when a lot, like the biggest amount of the outperformance occurred sort of after the banking crisis. So you had this combination of the bank stocks and a lot of financials and smaller cap companies that had, these ties to these banks doing poorly because of that. And then you had this AI boom that caused the bigger tech companies to do very well. So you had this sort of idiosyncratic event that occurred, or these two events that occurred that caused this massive dispersion, right?
Right. And if you think about it, who gets hurt more when the banks start to struggle, when those smaller cap banks started to struggle? Who gets hurt more when the Fed raises interest rates, right? You have large cap companies, a lot of them have so much cash on their balance sheets that they actually benefit from higher rates, right? Because they're earning more on their cash that they're holding, right? They're actually getting a higher return from a quote unquote risk-free asset. Smaller mid cap companies, they're the ones that need to rely more on borrowing, more on debt, more on, getting that new investor, that new private equity investor, or so on and so forth, to make that investment. So they're going to be more susceptible to the environment. They're going to be more, hurt by that increase in rates, which then brings us to, okay, well then what does this all mean for next year, right? Well, if rates do start to come down, who do you think is going to benefit the most from it? probably the smaller and mid-cap companies who now don't have to borrow as much, and then have X amount of borrowing subtract from X amount of returns to get to their, their bottom line performance, right? That dispersion is going to grow, where they're going to be able to reap more of their profits, right? And that's going to reward shareholders theoretically, right? What also interests me too is forward PEs. So the top 10, I've heard from clients that, don't you think the market's looking a little expensive? It's at all-time highs, et cetera, et cetera. Well, one, typically strength begets strength. So when you're at an all-time high, you're more likely to see a new all-time high than you are to go down from there. So just being at all-time highs does not mean that we should expect the market to start to come down. And then when you look at PEs, if you take out the top 10 stocks in the index, right, you actually, start to see valuations that are really along track the 30-year average for valuations.
Yep.
So we're not seeing that the market as a whole is very expensive. Yes, the bottom line number, and I'm drawing a lot here, sorry. When you look at this, even if you look at the S&P 500, as a whole, the PE doesn't look that bad. It is a little higher than average, but it doesn't look that bad. But once you start to take into account that just these top 10 names led performance last year, right? Those are the names that are looking more expensive, and they may be justified in how expensive they are. And then when you look at the rest of the marketplace, your rest of your opportunity set, that actually just looks about average. So we're not seeing any worry based on valuations from an overall market standpoint.
No, we're not. And I love the strength begets strength, coin and phrase and analogy. It's really true. And you can see it here on the right chart. We've shown this in the past, actually, but what we tend to see is after these stretches of mega cap outperformance, the market does better than average over the next 3, 6, and 12 months. Okay. And it's not, oftentimes we think, okay, well, those big stocks have to come back down to earth. No, that's actually not the case. What you tend to see is that the rest of the market, there's a catch-up trade that occurs. Did you have the returns handy for the last couple months?
Sure. So the last 6 months, the S&P 500 and the Russell 2000, so U.S. small cap stocks versus large cap stocks, had roughly the same return, a little over 7%.
That was the back half of last year.
Back half of last year.
Small caps and large caps did exactly the same.
And then if you look at from the end of October of last year to 12/31 of last year, the S&P 500 was up 14%. The equal weight S&P 500, so not weighting it by market cap, but just equally weighting everything at the beginning of every year, that was up 22%. And small caps measured by the Russell 2000 was up 22%.
Wow. So there you go. That was the end of the year was, yes, mega caps did well, but there was actually a catch-up trade occurring. Hopefully that continues on here into the new year. That would be great to see.
And that catch-up trade was really sparked by the Fed, right? You could see right when the Fed, we started to get news from the Fed briefings that, we could be at peak rates, right? That's when these other asset classes, the smaller mid cap, the non, mega caps started to really shine.
So where are we at for 24? Where are these forecasts at for 24? And we don't have a slide on this because, again, the estimates that came out and where the market closed were so disjointed by that fantastic year-end rally. But I just wanted to point out a couple folks, go figure, people are projecting a 6 to 10% return on average. Okay, great. Let's throw that out. I would guess it's either going to be a flat year or maybe a little bit down or probably another 20% year, flip a coin pretty much, right? But I wanted to highlight 2 forecasts and read them to the audience because I think it's worth noting. Okay. The most bearish forecast on the street is JP Morgan. They have a price target of 4,200. I don't know if that has since been revised up, but they were projecting, essentially, they think that growth next year is going to slow and eroding household excess savings and liquidity, something we've touched on here a lot, as well as tightening credit conditions will hamper the consumer in 2024. their consensus, or they think that the consensus view of 10% earnings growth next year is unrealistic because of that. So they think negative corporate sentiment will kick in and should be a catalyst for lower estimates early next year. So their price target is a bearish one at 4,200. Now, this one is where I get a kick out of this one, but there's a firm called Capital Economics. No idea who they are. I've never heard of them. They have a price target of 5,500 on the S&P. What is that, a 20% return from where we closed the year? That would be great. But listen to this commentary. They said there's still time for the S&P 500 to party like it's 1999. It has come a long way lately, thanks to both a rise in valuation and an increase in expected future earnings. This partly reflects investors' enthusiasm about AI technology. If AI enthusiasm is inflating a bubble in the S&P 500, it's one that is likely still in its early stages. We think the index could therefore make further gains, and our year-end price target is 5,500, or about 20% above current. So I just thought that was interesting. They're not forecasting for a good reason, right? They're just saying there's going to be a bubble, and that's why stocks are going to go up. My guess is if that happens, they think it's going to eventually pop. But I wouldn't put a grain of salt on either of these. Stick to your forecast, stick to your plans. Whatever a diversified portfolio means to each and every one of you, and is going to help you get towards your goals.
Right. Now, we do have an election, right?
That we do.
We have an election coming up this year.
Today is the New Hampshire primary. If you haven't seen enough news about it yet, you certainly will by the end of today. But we're sort of kicking off election season here today, which is great. So what a fitting time to talk about this. What do we have here?
And we will have a future podcast that jumps into elections at a deeper level, both what's going on in the current election and then market returns. This is more of a general slide here that we thought was very telling. So what we're looking at, each of these bars is the annualized performance of the U.S. stock market under a different political regime. So on the left, we have under a Democratic president. So going to the left, we have a Democratic president is in office. And then on the right, we have a Republican holding the office. Then we further break it down by the makeup of Congress. So right here, this bar here, this is a Democratic president and then a Republican Congress. Here is a Republican president and a Democratic Congress. These are historical returns. These aren't projected returns, nothing like that. What I find interesting is I would expect that a Republican president and a Republican Congress would be associated with higher annualized returns for the S&P 500. However, what we find is a Democratic president with a Democratic Congress has been associated with a higher return on the S&P 500 historically. Now,
that's interesting because let's take a minute to dive into that. Why is that, right? Republicans are typically, lower spending, lower taxes, more pro-market, right? Pro-free markets, I should say, right? So those are all typically thought of as more business-friendly things. So I would agree. That's the I'll call it a stigma that you tend to associate market returns with a political party.
Right, exactly. And I don't think that this dispersion here is enough to make investment decisions off of. I think it's still too close. When you look at the data, when you get, on a different level of nerd with statistics with it, I wouldn't call this statistically significant in terms of making investment decisions off of. No. What we find, though, when you dig into the whys is a lot of it has to do with the balance of our political system. Typically, when you have a Republican in office, right, who's to follow a Democrat, and then a Democrat has their terms, and then a Republican follows. And you really see that back and forth. And whenever, you look at someone's presidential term, they generally don't put forth too much forward that will impact the economy over the short term. Typically, they're putting forward very few items, and those items have a multi-year impact on the economy. It's not going to impact that year or the year after, et cetera, or at least not a strong impact. So you find this balance where a Democratic regime may take us a little farther left, and then a Republican regime will take us a little farther right. And those two kind of mesh together because we always see the long-term impacts of that hitting our economy. So that real balance is helpful. Now, another takeaway here is that when we have a split where Congress is split, we have a Republican president or a Democratic president, returns are generally higher. It's because the market likes certainty, right? So what we could expect, talking about uncertainty, what we could expect this year is as we get closer to the election, I would expect uncertainty to build and the markets to become more volatile. As soon as we have the election, regardless of who's in office, it is reasonable to expect that the market will do better from there forward, right? Because there is more certainty. If you think of yourself as a CFO of one of these big companies, if you don't know what the political environment is going to look like going forward, how are you supposed to optimize your business, right? But as soon as you know what the political environment is going to look like, what potential taxes you may need to think about, what the environment is going to be for mergers and acquisitions, et cetera, you could then start crafting your strategy for optimizing your business in that environment. So it's really that certainty or uncertainty that we want to pay attention to, and less about who's holding office, at least historically, when you look at the historical data.
Right. I think it's interesting. I mean, we said before, Republicans are often seen as the more business friendly, right? And Democrats less so. But what's really interesting is we tend to extrapolate our beliefs and, overestimate the actual business friendly nature of those folks or lack thereof. And I think what's interesting is what you tend to see is, first of all, election years they tend to be back end loaded years. Okay. So the back half of the year after the election, after that uncertainty is alleviated, tends to be better for the markets. So again, playing into the volatility theme we've been talking about. But let's say a Democrat's elected and that's seen as less business friendly, you might get a more muted back half of the year in terms of the market reaction. And then what happens when they come into office, right? They stop pandering to their base. They move towards the middle. They have to work as the president of the whole country. And the expectations that we're poor, it's not, the bar is set low. It's not hard to beat those expectations. And that's what stock prices are and are based off of, and can rally and do well in that type of environment. With a Republican, on the other hand, you might see a big bump after the Republican wins, right? You might see a big bump because there's all this enthusiasm. But once they take office in January, what happens? They have to be the president of the whole country. They move towards the middle. They stop pandering towards the base, right? And then maybe you set up for, you set the bar really high, and then maybe the reality is still very good, but it's not over that bar, and you tend to have a weaker year the year they're actually in office with a Republican president. So whichever way we get the returns, I don't think anyone cares, but you just have to be aware that there are these relationships and it all plays off of investors' expectations.
Right. Now, a little bit of a fun fact, there is research regarding a relationship between the stock market and the election. And it's not so much the election pointing at an implication on stock market returns. It's really stock market returns pointing at an implication on the election's outcome.
Okay, I'm listening.
So research indicates that the stock market performance leading up to an election serves as a significant predictor of the election outcome. Positive performance from the S&P 500 during the 3 months immediately preceding the election has been a strong indicator that the incumbent will win. Negative performance, on the other hand, is a signal that the incumbent will be defeated. Now,
how strong of a signal is this, though?
So this is actually very interesting. So the indicator has been correct 87% of the time since 1928, and the accuracy has risen over time. So since 1984 until the last, from 1984 to the last election, the indicator has been correct 100% of the time, which I think, you take a step back and think about it. It makes sense because if if you're going to reelect the incumbent, right, generally speaking, there is less uncertainty there, right? You already know what the incumbent is going to do, or what their ideas are, their platform is, right? If we start talking about, someone new coming into office, that creates more uncertainty. So I could see why they're related. I don't think the election at all points to the market. I think, as the research indicates, the market pointing at the election. It is interesting.
Very interesting. Yeah, there's a little bit of recency bias in there, right? If I'm feeling good, the market hasn't been volatile in the last couple of months, then okay, maybe the guy in the office is doing a good job. But if September and October are not good for the market, then maybe it's time for a change. Yeah, people are pretty. I think that resonates with how we look at behavioral finance and people being short term, backwards looking. That's
Right.
great. It's a good stat.
So we did.
So 2024, right? We're not going to make a forecast, but hopefully that gives a nice outlook of the year ahead.
Well, and I think the takeaway here should be you shouldn't be looking for a forecast, right? The forecast should be what's going to happen over the next 5 to 10 years, which we've talked about interest rates, we've talked about trends in the markets, we've talked about valuations. Those trends are the trends we want to follow, not necessarily the 1 year trends. So it's not so much that we don't have a 2024 outlook. We have a longer term trend, and 2024 is going to play a part of that. But when you focus too much attention on that 2024 outlook, you start making investment decisions just based on that 1 year period. That's when you run into trouble.
Yeah. So we did have a couple questions. We answered a couple questions that had come in. We had two more. There was earlier this month, it was a pretty groundbreaking moment, actually. The SEC approved Bitcoin ETFs. So someone had asked about crypto, Bitcoin, how the ETFs are being formed by different groups like Blackstone and other banks. We are actually going to have I believe it's our next episode of our Amplified Wealth podcast, will be solely focused on Bitcoin and the crypto landscape. But then other types of investments folks asked about, such as closed-end funds. Any comments there, Austin?
So I would just say when you're dealing with the closed-end fund arena, you're dealing with that type of investment. What you're investing in is a pool of assets, just like with an ETF or a mutual fund, except there is generally a high amount of leverage involved, or at least a decent amount of leverage involved. So you want to be cognizant of how much leverage they're taking. And then you also want to take a step back and think about yourself as an investor. Are you the type of person that likes to or is okay with leveraging your own account? Like, are you the type of person that will go on margin to enhance their returns, right? If you're not that type of person, right, a closed-end fund may not make the most sense. It may make sense to find a similar sector or investment, a fund that focuses on that specific type of investment that doesn't include the leverage. What the leverage does is in good times, it makes the performance look great. And then when things turn, though, generally they turn a lot quicker in a closed-end fund because of that leverage experience. So, I can see why certain people may look at a closed-end fund and say, wow, look at those returns. I want that. However, what you're not seeing is when you really dig in deep to the peaks and the troughs of some of these investments, when the market starts to sell off, when that asset class starts to sell off, they get hit pretty hard. They can get hit twice or even harder, as much as finding an investment that doesn't include that leverage. So I would say be very cognizant of that. Be cognizant of what type of investor you are. Not get too caught up in past returns. Especially the past couple of years, unless you're really going to dig in deep and say, all right, where were the highs and the lows for each year going back to the inception of this fund, and really imagine yourself experiencing that volatility. I would also say that
experiencing that volatility, but also relative to what the market's doing, right? If the price of that investment is flat or going down 5%, even if you're getting 10% income, and the market's up 25% like last year, are you going to be okay with that? Or are you going to stick with that part of your portfolio?
Right. And the best person to really ask the question too of a specific investment or a specific investment type would be your advisor. They're going to know you. They're going to know your overall wealth plan. And so I would suggest you reach out to them. If you don't have an advisor, obviously reach out to us. We'd be happy to get you in touch with someone that's in your location to have that more expansive conversation.
Well, we are bumping right up on 1 o'clock now. So I'll take a moment to thank everyone for watching, listening, tuning in. Definitely keep an eye out for the Amplified Wealth podcasts. We've been putting out some great content, both from a market perspective, as well as a financial planning perspective. Those are our according to plan episodes, which you'll see in the title. You can search for Amplified Wealth on Spotify or Apple Music, wherever you listen to your podcasts.
Great. Thank you, everyone.
Thank you, everyone.